Hello viewers, and welcome to today's episode of the Mrs. Amma Show. This is the Money Talk segment, and this is where we get to talk about money matters, about how to empower ourselves to have that culture of savings, planning for the future, planning for the family, and all of that. So on today's Money Talk segment, we're actually going to be delving into the topic of marriages and finances. I did an earlier vlog on marriages and finances, basically just asking the question, do they go together? And the conclusion really is they should go together. Couples should come together and plan together for the family. And that definitely includes finances in the home. So on today's vlog, we're going to take it a step further and talk about the concept of life insurance. If I were to go out there, just go out to the streets and do a poll, take a poll of say 100 couples. And if I were to ask them if they have life insurance, I can guarantee it that majority of the responses will be a big fat no. And even the few who happen to have life insurance, if I were to delve deeper into the adequacy of the life insurance, what I'll find is a lot of them are not adequately covered. So why do couples tend to shy away from talking about life insurance? Why do people in general, maybe not even couples, just people in general, feel trepidations when talking about life insurance? Is it because they associate life insurance with the concept of dying or with with their mortality? I mean, people should know by now that there are three things that are inevitable in this life. One is you pay your taxes, you have to pay your taxes. Two is change. Change is inevitable. And the third really is death. Death is inevitable. Doesn't matter, no one lives forever. It's a known fact. No one lives forever. So the sooner we face the question, maybe not the question, the sooner we prepare and plan adequately for that time, the better we will be, or the better our families will be. Couples really need to come together to talk about the event of a death in the family. So if there's a household that has got one single earning person, so maybe one spouse works, does the 9 to 5 while the other stays home working, looking after the kids and the home. I mean, in the event that there's a death, or heaven forbid that something happens to this young family or to the breadwinner, what then happens to the family? What happens to the other spouse that's left behind, or what happens to the young kids? I mean, couples need to be thinking about this and thinking about making investment decisions that help to secure the family's future in case there's a death in the family, or the breadwinner passes on, or whatever it is, right? So the other day I was speaking with a friend, and the friend was like, as a single person, and the friend was like, hey Mrs. Amma, okay, yeah, all fine and dandy, I hear what you say about life insurance, but I'm a single person, I really don't have dependents, my parents are all doing well, fine, they're elderly, but they're well-to-do, my siblings are all doing well, they have good jobs, so do I really need life insurance? Okay, if you fall in that bucket where you're just a single person, you really have no obligations, no dependents, then yeah, maybe you don't need life insurance. If you also take stock of your net worth, so if you have a net worth that's positive, in which case your assets are more than your liabilities, and you can pretty much, and you have a good job, and you can pretty much take care of your expenses and your debt, yeah, then maybe you don't need life insurance. But for the majority of us, the rest of us who have young families, we've got mortgages, we've got maybe student loans, we've got young children, we have to think ahead of, okay, how do we pay the school fees and how do we care for them? We definitely need life insurance. There are two types of life insurance, two flavors of life insurance out there. One is what you call a term life, and the other is what you call a permanent life. And even the permanent life can be broken into two further subcategories: whole life and then a universal life. So what is a term life policy? So what's the difference between these policies, and how do you know which one to go for, and how do you also know how much coverage to go for? So a term life is pretty much what it is. It's you getting coverage for a certain length of time, typically 10 to 20 years. So it's a term life, it's a life insurance policy that covers a certain length of time, typically 10 to 20 years. And the permanent life is, you guessed it, is the opposite. So it's a life insurance policy that pretty much covers your entire life. This is assuming you keep up with the premium payments. You don't miss a payment and you keep making the payments. So it's pretty much an insurance policy that covers your entire life. Now, the question of which to go for or how much to go for, it really depends on your particular situation and your family's particular situation. What I find is term life insurance, I think, tend to be adequate because you really only need coverage. That's my opinion, but I strongly believe that you really only need coverage for a certain length and time. So, for example, if you've got young children or a young family, you don't need life insurance for forever and ever. You just need it to cover the period of time when your family is growing. But by the time your kids are done with college, they've got good jobs, they can pretty much fend for themselves. You don't need that life insurance again covering, them as dependents. They're no longer your dependents. They're now adults in their own right. So for term life, I would say, and they're cheaper. Two is term life tends to be cheaper because they only cover a certain period of time. They're cheaper than the equivalent permanent life that tend to cover your whole entire life. So in my opinion, in my household, my husband and I, we personally have term life insurance. It suits the needs and we're okay with it, or we're happy with it. So that's that. Then two is, how do you know how much? So, again, another friend was asking, so how do I know how much coverage to get? There's so many policies out there with various coverages, various amounts. How do I know what's adequate for me and my family? So it depends on your situation, and each family has a unique situation. But there are 3 rules of thumb in this case for you to analyze to figure out how much coverage you need. So number 1 is all of your debts. So put together a list of all of your debts. So all types of debts, consumer debts, so your car loans, your credit cards, your mortgages, all of those debts, just list them out. And depends on how much that total comes to, your life insurance policy should at least be able to provide coverage for that amount. So hypothetically, let's assume you've got a mortgage. Total mortgage left on your house is $350,000, and you also have a car loan that is $20,000. So $350 plus $20,000, that's $370,000. You ideally want an insurance policy that will cover up to $400,000. So that's 1 is how much debt you owe will determine how much your insurance policy is. 2 is what I call income replacement. So you want an insurance policy with enough coverage to cover future earnings of your current income. For example, if you currently earn $40,000 a year, and you want to take out a term life insurance for the next 10 years, you ideally want that insurance coverage to have enough to cover 10 years worth of your $40,000 annual salary. So again, you want the insurance policy to be able to cover at least $400,000, which is the $40,000 a year times 10 years, $400,000 of your income. Now, when you take that $400,000 from income replacement calculation and add that to the $400,000 we discussed to cover your debts, now you're up to $800,000 of potential insurance coverage. Number 3 is what I call future obligations. If you've got dependents, say you've got young children, you've got 2 young ones, and you know that you're going to have to put them through school, put them through colleges, and you already have an idea of how much the college is going to cost. And let's just say hypothetically it costs for the 2 of them $30,000 for 4 years. All of a sudden, you've got $30,000 times 4 years, which is $120,000. You also want the insurance policy to cover the $120,000. So if you take the $120,000, add it to the $400,000 income replacement potential, and then also add it to the $400,000 debt that you owe, all of a sudden you need an insurance policy that will provide coverage of at least $1 million. So that's the approach that I would take. Those are the 3 rules of thumb. You can never go wrong with it, and like I said, each is going to be unique for each family's situation, because no 2 family situations are alike. Now, couples or spouses need to come together to plan for the family. There's no point one couple going off on a tangent or the other being disinterested in talking about life insurance. The couple, spouses who plan together work together. So spouses, or maybe the other way around, spouses who work and plan together succeed together. So couples should come together to determine what life insurance company they want to go with, what kind of policy they want to buy. Do they want to use a broker, or do you want to go out there and buy it, by yourself? You also need to be very cognizant of the terms of the policy. Read the fine print. And there are 2 specific terms I'm going to call out here that you need to really ensure that you read your policy. Once you decide to settle on a company and a policy, make sure you read the fine print for these 2 terms. The first one is what I call contestability period. This is pretty much a length of time, typically 2 years, where the insurance company can decide to contest your claim and decide not to pay out your claim for whatever reason. And it's typically due to errors, whether knowingly or unknowingly committed by you. Let's take, for example, you get the spelling of one of your beneficiaries wrong. Guess what? The insurance company can decide not to pay out to that beneficiary, because all of a sudden, even though you were thinking, so let me just take for example, you meant to put down your daughter, and your daughter's name is, just say Sarah Amma, Sarah Amma. You meant to put down Sarah Amma, but then you wrote down Sare Amma. The insurance company is going to look at that and say, you know what, that could well be a totally different person than your beneficiary, and they could decide not to pay out, and they are well within their rights to do so. So ensure you read the contestability rules, know what the length of period is, know what the rules apply to, and be aware of that. The second item you need to be aware of is what I call the exclusions policy, and pretty much, or principle. And pretty much what this means is insurance companies will typically not, so they have a clause in there, or exclusion clause. They have a clause in there that says they will typically not pay out any death benefits if your death is due to your negligence, or if your death is due to you taking illegal substances. So for example, if you overdosed, if you OD'd on, I'm just going to put it out there, not that you're going to OD on anything, but you OD'd on crack cocaine, the insurance company may well deny your beneficiary's claim to your life insurance policy because your death was as a result of you overdosing on an illegal substance. So illegality, you need to be aware of the terms. Another example could also be if the insurance company could deny your claim or your beneficiary's claim for your death benefits if your death was as a result of your negligence or you doing an illegal act. Okay, fine. You're not gonna go out there and become like a Bonnie and Clyde where you're, robbing banks. No, that's not. No. So I'm hoping you're not doing that, and I definitely know you're not doing that. So that's not what I'm talking about. But even a law-abiding citizen can get in trouble here if you're not careful. Let me give you an example. You're driving on the highway, and all of a sudden your car comes to a screeching halt and stops. You try to revive it, and you look at your dashboard and you see that you're actually out of gas, or you're out of fuel, and you start to panic, or then you take a step back. You're like, okay, you know what? I think I have a can. I've got a keg, in my trunk. You get out of your car, you take the keg from the trunk, you look across the highway, and you actually spot a gas station across the highway, and you decide, you know what? Let me just make a dash for it across the highway. Let me just go buy gas real quick. There's no point, walking 10 minutes, climbing up the overhead footpath to get to the other side. Let me just quickly, I see traffic, let me just quickly make a dash for it. And guess what? in making a dash for it, you get hit by a car and die, the insurance company are well within their rights to deny your insurance claim because you committed an illegal act. You ignored taking the overhead footpath and decided to make a dash across the highway, which is illegal, and you died in the process, or you got hit and died in the process. They could deny your beneficiaries the claim. So couples, let's not be dumb. Pay attention to those clauses and let us make sure we continue to be law-abiding citizens in the spirit of the letter, to the letter. Don't make any kind. Now is not the time to experiment. Now is not the time to think about your future here and think about your family's future. Don't do anything crazy. Definitely don't go dashing across the highway. That is just unnerving, and that is just illegal, and that's just wrong. So just avoid it. There's no point endangering our lives. So keep an eye out for those two. One is the contestability period, and then the other is the exclusion clauses. You want to make sure you read the fine print and know what those are about, and just understand it. So spouses, get together, plan together, make sure all of the information on your life insurance application is as accurate to the best of your knowledge. Now is not the time to get spellings wrong or names of your beneficiaries wrong or any other kind of information wrong. You could pay dearly, actually not you will pay dearly for it. Your beneficiaries will pay dearly for it, and that could mean leaving money, good money, on the table. Don't want to leave money on the table now. So ensure you plan for your family's future, secure their future. If you've got a young family, go and get life insurance. And make sure the life insurance you get, term life worked great, is adequate. Get adequate coverage based on the 3 rule of thumbs that I gave you, which is the amount of debt that you owe, your income, replacement of income, as well as future obligations, such as school fees for your children. So go out there, plan together. We can do this. It takes planning. But once we plan together and we work together, things are seamless, and they move seamlessly and are achievable. So you stay well.